Well, hello, good afternoon, happy post-Fed day. This is Danielle DiMartino booth. Welcome to another deep dive. I don't have an earpiece in, yay! So that's because I'm here live in studio with Katie Stockton. She is a great friend and she knows everything I don't about charts. She is a chartered market technician and she runs her own business just like I do. She's the founder and managing partner of Fairlead Strategies. Yes. And I've got a Tudor horn. I mean, when you have post-traumatic stress syndrome like I do from working inside the Fed, where they create all of the money out of thin air, you tend to be more bearish than you would otherwise, which is great. I make a lot of good calls.
It's healthy.
on the short side, but it's been really hard to get bullish, but yet you've been, and I finally learned how to quit fighting the liquidity, quit fighting the momentum. There are certain things you just can't fight in my world. But your world's completely different. So first of all, give us a tiny bit of background. I mean, we see you everywhere. You're very famous. But give us a bit of background on, I mean, did you like in statistics, were you like, I want to be a chartist?
You know, to some degree, yes. And thanks for having me, Danielle. It's good to see you. And this is my home turf in Stamford, Connecticut,
we're in the
no
CT.
less. I
Yeah.
know, I love it. So, you know, to me, technical analysis always resonated. I was introduced to it very early on in that there was actually coursework at my university, believe it or not. It was one of, I think, 12 universities at the time that had coursework in technical analysis. It was graduate level, so I just audited it. I'd already had some exposure with an internship, Dorsey, Wright and Associates, if you've heard of them. They do point and figure charting. So I've gone away from the point and figures, but it just set me on the path very early on when I was already on the finance track.
Yep.
So it just seemed to be something that I was exposed to. And then what happened was some of the sort of big time players in technical analysis, like Ralph Akampora, came to visit us at school. And so when you have these practitioners who'd had such big calls and big personalities to match them, it really is inspiring as sort of a young budding technician.
Think of one who I met when I was young. Is it Yamada?
Louise Yamada. Yeah. She actually just did a webinar for our client base, and she is fantastic. She's sort of semi-retired, I would say, but still staying very close to the markets, and she's called this secular shift in treasury yields. So that's why we had a talk, and I concur. I think we've also seen that, but she has much bigger long-term calls. And I think to your point about approaching things very differently, but sometimes arriving at the same conclusion, you and I. The momentum is a real force behind the markets, and our analysis is all price-based. So it doesn't answer why something is happening, but that's why we have you, thankfully.
Right.
But it will tell you what's going on, and in the indicators that we have, the technical tools, we can come at the market with it's sort of a perspective that's unemotional and somewhat unbiased, at least to some degree, because it's somewhat mathematical. So we have these tools.
The opposite of the world I occupy. I come at it with a ton of emotion.
That's okay too. So when you combine them, I think that's where you have the most powerful call. So if you have technical analysis on your side, fundamental research, and also macro inputs, that's where I think you get the most powerful sort of complete view holistically. And so we are only technicians. So our hope is the research that we write and the consulting that we do is taken within that broader context. So we really believe that the drivers behind prevailing long-term trends are our earnings, our macro data, but sometimes things get disjointed, and that's where the charts can really come in handy.
Well, I mean, if we flashed back a month, even just 1 month, you could not get out of the way of the Dow. It was just leading the pack. And now, as we sit here live, you've got the NASDAQ ripping up more than 300 points on one stock that is like, we're going to cut so many costs that we're going to fire so many people that we're going to rock it. I'm like, They're going to buy back $40 billion of stock. I'm like, okay, that'll give something to shareholders. But we're coming through an earnings season where investors in many ways are awarding bad news out of companies. Well, bad for their employees.
Yeah. The sentiment's been really interesting to me, especially year to date. So in December, things were sort of making sense from a technical perspective, where we saw the normal reaction, if there is one, to an overbought reading at the start of that month. And we came into the year thinking that we would remain firm sort of through the seasonal influences in the very beginning of the year. But by no means were the charts supporting, in my work, a rip up like we've seen.
Yeah.
We could even call it almost a melt up as of today.
Sure.
And a lot of that has been driven by the likes of Meta and Tesla, these mega cap growth stocks that I think people are so excited to see finally rallying again after such prolonged and pronounced down move. So, the rubber bands must have stretched too far on the downside, and we have this sort of spring up. Now, the nature of that relief rally that we've seen, especially over the past 3 weeks or so, has been really sort of fast and furious. And that fast and furious nature, unfortunately, is more indicative of a counter trend move typically than something that's like a sustainable turning point.
So what we would call a bear market rally.
That's right.
Another bear market rally.
That's right. And there are some differentiating factors between this rally and the one that we saw fail in mid-August. It's a bigger rally for most, so we've seen a little bit more upside. We've seen more breakouts. A lot of breakouts are sort of pending confirmation on a closing basis in our work tomorrow. So it'll be really interesting to see how we trade between now and tomorrow's close. We have a lot to plow through in the way of earnings, and also data between now and then. But to me, that's promising, but still far too early to say that the October low was the low, right? And not just a low. And I think that's the thing that kind of holds in the balance of the near-term price action. I think we feel pretty confident that we'll see some kind of retracement, and it's going to be a question of whether that retracement follows a breakout or not as to whether we're likely to undercut those lows.
So before we get to where you see the broad markets headed, short-term, long-term, and then we'll get to bonds, my world. Before we go there, especially in light of what we're seeing today, can one stock throw off a market, throw off an entire trend in your world?
Obviously the mega caps have such a massive influence, and especially on market sentiment. So I think briefly, yes. I think you can have that sort of behavioral element manifest itself, but I don't think it's necessarily something that could be long-lasting. We watch things that are transactional gauges of market sentiment, like the volatility index or VIX, and the VIX has been really kind of depressed, is what I would say. We're thinking about the VIX as being in this higher volatility cycle. So it's when you have a higher floor than previously. So let's say the floor in the VIX used to be maybe 11 or 12.
Right.
Now it's maybe 18 or 19, and that's being tested right now. So this high volatility regime has been characteristic of the bear market cycle, and that's not uncommon. We usually see sentiment get far more bearish, and that becomes a bullish indication from a contrarian perspective before a bear market cycle culminates. So that's been the big question, and I know that you wanted to address that today.
Well, and I mean, because I think it's intriguing. We've got like Apple after the close today, Amazon after the close today. I mean, any one stock, it seems like, can completely shift sentiment in the markets and can completely. It can either compound momentum or it can arrest it.
That's right. Yeah, and I would argue that Tesla has kind of done that already. But we have to frame it from where Tesla came, which was a nearly uninterrupted several-month downdraft. So not to minimize the percentage gain off the lows, but again, it's that kind of fast and furious nature of it that gives me a little pause in wanting to chase it or even calling it the end of that downtrend. We are seeing on a long-term basis some early indications that major lows are being put in place by like higher growth names that started downtrending earlier, like in early 2021. That does not include Tesla, mind you. So that would be cloud computing stocks, for example. So they'd had a chance more to find a footing before what we're seeing now, as opposed to the ones that just really kind of were tanking ahead of the relief rally. We think those are not as well positioned. We, after a bear market cycle, like to see support discovery, meaning something that kind of bounces along the bottom and finds buyers repeatedly. And I wonder if this year, I do think it probably is an inflection year, but that will get into a bit more of a trading range, which can be a super frustrating environment to
yes.
trade throughout. But that trading range can then serve as sort of a basing phase.
So, it's interesting because Bank of America came out a few days ago and they were like, we think we're about 50% of the way through layoffs in tech. And kind of from a fundamental perspective, you're like, they're ripping, but yet there's more bad news that's being stored up. And so, I mean, from my perspective, that's when you say bumping along the bottom, we're not there yet.
Right. We haven't. Yeah, we've bumped off the bottom, but the retests have not really happened in earnest, except in those really higher growth names, like a PayPal would be a good example of one. So we have seen some of that, but it's too early to say. I think that we're out of the woods from that kind of scenario, and we have to differentiate what we saw in 2022 from a corrective phase, which is all what we're accustomed to off of the COVID low and what have you, the V bottoms. I think to expect this to be a V bottom that doesn't look back is really hopeful, because we've not seen a bear market cycle end that way, at least in my market history, which is about 25 years. And when I go back and I look at the indicators, which is me trying to be less emotional about what's happening, we'll look at the indicators like the MACD, so that's a momentum gauge, or the stochastics, which are an overbought, oversold gauge. And they're actually set up fairly similarly to early 2002, following a 25% relief rally off of the low. And it's not to say we are in store for another one of those years, which was a terrible year. But rather to say that, to be viewing what we've seen so far as enough, I think is a little hopeful.
So before we went live, I was just telling you that I ran into Michael Darda. And he, when he was presenting at a conference that we were at last week, he really surprised a lot of the people. Because he's like, I know I'm viewed as being a perma bull, but what we've seen is reversing. And a very long-term trend of the United States outperforming other international markets. Michael Hartnett at Bank of America, he puts out the Flow Show every Thursday night. And he's shown this turn where U.S. market capitalization was 66% of the world. And Darda was of the view that that's been a rip for a generation.
Yeah.
So the way he characterized it was the S&P, the U.S. stock market capitalization was 5 standard deviations north of where it should have been. And now it's back down to just 3 standard deviations, a 99.7th percentile probability, meaning it's still very much stretched.
Right.
Whereas, and so he was saying, don't take this the wrong way, but this could last years.
Right.
Plural.
Yeah.
Does where are you seeing the market on a short-term basis? And when I say short-term, I'm like, well, what's short-term in your world?
I know it's probably different, I think, than your world.
Yeah.
And that's okay, because I actually think the charts and technical analysis, while they have a reputation for being ultra short-term and for day traders, it's not at all the case. You can apply any indicator over any time frame. We could apply it to quarterly data if we wanted to. But what I value in it is that it does kind of help fill in the blanks, right? So if we're waiting for quarterly data, well, gosh, it's good to have some information intra-quarter from
in between
momentum gauges and what have you. So my short term tends to be days to weeks, so maybe up to about 6 to 8 weeks. And then my intermediate term centers around a quarter, and my long term is about 6 months plus. But what I will say, and it's nice to hear Darda's name, we used to work together at MKM Partners for many years, and I really respect his work a whole lot. I think with what he's saying, I think that sort of the double-digit bull market years that we've seen, maybe we won't have those in the near future. And I say that because of potentially that secular shift that we've seen in treasury yields. And then I like his point about the international markets. I think it's still in the charts too early to say that that's a lasting shift, but I certainly think it's a shift that's relevant for this year. It already actually manifested last year in the ratios. So if you looked at developed global or emerging markets versus the US, they really stabilized last year. And of course, this relief rally that we've seen has been very impressive and has drawn attention now to that area. But it's not like a multi-decade reversal or anything of that nature at this point, but certainly more of like a neutralization between the two, between US and international, that I think is kind of interesting. But, you know, I think we have to trust that, you know, we might not be in store for those sort of prolonged long-term uptrends driven by technology. It might not all be about technology going forward. We already see the sector sort of losing its foothold to some degree in the S&P 500. By the way, they're rebalancing the weightings, and that's what I suspect. As you know, maybe it's not going to be all about Apple.
Well, I mean, so if long-term to you is 6 months, you know, I've followed your work for years and years and years now, and the persistence of the bull market, you know, your long-term kept getting longer and longer and longer, and it was right.
Yeah.
There was just this constant rising floor underpinning the stock market, and I think that's what that's what a lot of investors don't quite understand. I mean, they're ready for the Fed to pivot, and they're ready for the Fed pivot to give us back the V and just have us go off to the moon. And there's an underappreciation, I think, for what persistence can do if and when you finally see a shift in momentum. So how does momentum play into?
I mean, hugely important.
I mean, you've got an ETF, right?
Yeah, we do. So we have the Fairlead Tactical Sector ETF, and the ticker is TAC or TACK. The goal of that ETF is to leverage sector momentum on a long-term basis.
Okay.
And as an investor, I think being long-term is the best way to be, because you're not getting caught up in too much noise and moving things around too much. I heard last year from my client base, their performance was okay in general, but they overtraded. They felt like they were too involved in a market that wasn't really rewarding them for that involvement. And so if you simply have like a long-term momentum overlay to tell you, is this a higher probability setup or not, that to me is invaluable, because, and we have great mathematical tools to get us somewhere closer to that. They're not going to be perfect, but just those monthly MACDs, for one, are going to at least tell you what is the long-term momentum behind the market. Right now it's to the downside still. It's to the downside behind the major equity indices. It's to the downside behind treasury bonds. It's to the downside behind Bitcoin. It just turned to the upside behind gold. So to have these longer term sort of momentum gauges on your side, I think is usually beneficial. There will be times, and even months at a time, where they won't be timely, but they still will help you understand the framework within which to view your other indicators, which can help you kind of refine and be better at market timing.
So let's talk about the different stock markets within the United States, because you've had the Russell 2000 going its own path recently. Obviously, the Dow has diverged from the NASDAQ, and the S&P kind of is somewhere in the middle with Tesla in it, which really throws around the S&P, which we kind of saw coming. And we both know Howard Silverblatt at Standard & Poor's. It was a big deal when they put Tesla inside the S&P, and they knew that they were adding an element of volatility that the index had really never had. Yeah. But what do your charts tell you about the different markets, different stock markets within the United States right now?
You know, we have seen relative performance from NASDAQ 100 stocks versus the S&P 500, irrespective of the S&P 500's exposure to those same mega caps. So, and the NASDAQ 100 has concentration in the mega cap technology names. So it's your traditional sort of Apple and Microsoft, and to a lesser degree Amazon and Alphabet. These are just the heavyweights that throw around the NASDAQ 100 the most. And we've seen outperformance over the past month or so from the NASDAQ 100. And previously, we saw outperformance from the Dow Industrials, as you cited. The Dow Industrials was partly driven by some cyclicals. So we had industrials, the sector, and materials outperforming, and that started to peter off a little bit, which then impacted the Dow Industrials themselves. And then kind of the baton got passed over to the mega caps. And now we have some interesting counter trend signals that are short-term in nature on the ratios of the NASDAQ 100 to the S&P 500, which is interesting because it suggests that the relative performance and upside leadership that we've seen from those mega cap technology names is probably going to peter off here. And then that creates a bit of a test for the market. Now, can the market maintain this uptrend irrespective of that? And that would be a real testament to the market breadth and participation that has been strong.
And when you say the market, you mean the S&P 500?
I do.
Okay.
Yes, I do. So that's what my primary benchmark would be. But it's, the relative performance there is looking a bit overdone.
And what about the Russell?
The Russell, to me, we saw somewhat sort of inline performance overall during the bear market cycle. So I think we kind of trust that we're in store for more of the same until we advance from it in earnest, right? So if we see the next bull market cycle unfold, I think at least in its early stages, you would look for the small and mid cap names to show relative performance. So that first kind of good move off the low, again, which I'm not convinced we already have,
right?
Would be something where you'd want to be maybe overexposed or overweight that area of the market. But otherwise, I think we have to trust that on an absolute basis that they'll just remain directionally in sync. So we tend to see in this kind of, I call it a top-down oriented market, and especially when the market's trending lower or sideways. It really is influenced mostly by these top-down influences, which are mostly macro, as opposed to rewarding fundamental analysis, bottom-up work. So with this top-down influence, I would suspect that most all of these major indices will bottom around the same day, and they'll peak around the same day. And so to try to differentiate between Russell 2000, S&P 500, it almost becomes a futile exercise because chances are very good that they're going to trade, pretty much in sync.
So before we came on, I tweeted out, what do you want to... I got all these Bitcoin, and it seems like the month of January has seen a breakout in Bitcoin that's gone hand in hand with the NASDAQ. I'm just looking from the outside in, but it seemed like there was like this ceiling of 1820-ish in 2022, and we've definitely broken free of that.
Yeah, we broke out of a consolidation phase in Bitcoin, and that consolidation phase had followed a major downtrend, and so the natural sort of takeaway is that we have a base breakout, and that's meaningful longer term. Now, we saw the 200-day moving average cleared by Bitcoin, and that was another thing that instilled some confidence, and on the back of that, we saw pretty immediate upside follow-through, which is, I think we had 14 straight up days from Bitcoin. I wish it wasn't like that, because if it was, a little bit more orderly,
right,
and more of a grind higher or a stair step higher, that's something that would read a little bit more sustainable to us. With the last up move, we saw a counter trend signal based on the DeMark indicators. The DeMark indicators for us are one of our preferred overbought, oversold inputs. They tend to be short term when you're using them on daily charts, and that's all we saw was on the daily chart of Bitcoin, we had a counter trend signal into the latest rally. So that tells us that rally is probably overdone. Now, what we'd like to see...
So similar signals from the NASDAQ 100 as from Bitcoin.
Yeah.
Which would... I mean, if you're looking at correlations, that tends to go hand in hand.
It makes sense. And yeah, that correlation is real and measurable. And with that, of course, we've seen the sentiment benefit risk assets broadly. So go down to the cloud computing stocks again, or even the meme stocks kind of picked up their heads.
Yeah.
So you see that
Somebody
sentiment
was like, Carvana is way off its lows.
It is. And maybe it's a long-term turnaround. It may be. But I think that
Katie, it's not. It's not.
I think it will be well served by waiting, right?
Yes.
Let it come back to us to some degree. And I would say the same about Bitcoin. I think it's not a proven bullish reversal yet, because what happens with such a swift up move, it doesn't have time to impact the long-term gauges. And that's almost like, to me as a technician, I see that as like a protection, because the longer term gauges are there to reduce noise, right? So they're still kind of treating that rally and that breakout as noise, like maybe not something that's ultra sustainable. And Bitcoin happens to be on its monthly chart very close to a support level, which I don't know if it's accidental, but it's the same support level that's in play for Tesla on our indicators. So it's called the cloud model, and it's something that we are starting to become somewhat known for, because it's a little bit of a unique indicator to us, but a great way to understand not only prevailing trends, but support and resistance, which is totally value add in my world. And right now, both Bitcoin and Tesla are pretty much right on this monthly cloud-based support.
Interesting.
Such that if they actually move sideways over the next month, they don't even have to go down, they're going to both break. So because of the nature of the cloud setup. So I'm watching these cloud-based levels very closely as it pertains to Bitcoin. Because they're in play, I won't touch it from a counter trend perspective. I generally shy away from counter trend positions unless you have the high conviction signals to support them. And after a relief rally, of course, those signals would go away anyway. We do have signals, as an example, in natural gas. Natural gas had a pretty major downdraft of its own. And with the last push lower, we saw some counter trend indications from those same DeMarc indicators. They have not given way to an oversold bounce yet. Collectively, they were somewhat high conviction, but with any kind of counter trend entry or position like that, you have to define the risk, right? So for anybody trafficking in downtrending securities, whether it's natural gas or Bitcoin or Tesla, I think to define your risk when you're going into the position is just the way to protect yourself. And that can be, for us, usually derived from a short-term support level. We'll take like a minor low and use that as a stop loss level. Some folks might just use a percentage-based stop loss, right, to manage the risk that's appropriate to them. We always say with stop losses, we don't like to put them in as sort of existing open orders, but rather watch for 2 closes below a level, and then that becomes your sort of confirmed breach of that level. So that's something we've been talking a lot about with our client base recently, because they are having trouble, with these counter trend positions and managing risk that's associated with them.
Which can be very expensive.
It can be, yeah.
So I wasn't planning on asking you this question, but it just popped into my head. So 25 years, we've pretty much been in the business the same time. There is such a thing as a star that falls from the sky and never comes back. There are stocks among us that have gone away.
Yeah, for sure.
Do charts ever begin to suggest to you that something is going to be, that you should short something and walk away? Do charts ever say something's dying?
Yeah, I think for a sell discipline in general, charts are completely added value, right? Because they take the emotion out of owning a position.
Right.
So sometimes for client portfolios, we'll run through them and simply give them output as it pertains to major sell signals. So these will be long-term, sort of long-only funds that just have exposure that they want to know if there's a significant enough loss of upside momentum or some kind of breakdown or a counter trend signal on a monthly chart. So for that kind of like unbiased sell discipline, charts are fantastic. If you're approaching it systematically, meaning regularly you're checking for these signals and acting upon them accordingly. So in those signals, you can certainly find these major reversals, and we're not just there to identify existing trends. We want to know when they're changing.
Right, of course.
So that's a lot of what we spend our time on, in terms of judging whether this might be a maturing trend or not. For something that's downtrending, though, we can't be ultra predictive in how long that downtrend might last. We just don't have a way to predict, right? But what we can say is as long as the downside momentum is behind it, we would stay with an existing short position. So I think of it as more of like a fluid analysis to say, okay, well, we don't know where this is going to be in a year or 5 years.
Right.
But for now, right, the downside momentum is very strong, is there. So we want to stay with that short position. So it's a great way to kind of time the entries in a short position that comes from a fundamental place. It becomes very complementary.
The second most asked question was, where's the dollar? That's, in my world at least, that's where there's the least amount of insights right now, because depending on how the wind is blowing, you don't know what Jay Powell's going to say next. And that really, in my world, that determines where the dollar's headed, is how. Is it going to be higher for longer? Is it going to be lower for longer? What are your dollar charts telling you?
We noticed last year with the correction, the longer term momentum gauges started to roll over, as you could imagine. It was significant enough to impact them. So we have a shift from upside momentum to now at least neutral, if not lower momentum on a long-term basis. And remember, our long-term is maybe 6 to 12 months.
Right.
Within that context, we have a pretty strong oversold indication. So intermediate term oversold conditions based on our stochastics with some DeMarc signals thrown in there to suggest that it sees a relief rally. But I think the shift is pretty meaningful. What it tells us is that it's probably range bound at best now, so that the next relief rally in the dollar will probably meet resistance below the previous peak, and that we get into more of a neutral situation.
That's so cool. I understood everything you just said. Yay!
Well, and I suspect the same might happen here, and this would only be relevant for the next 6 months or so for Treasury yields, if not already, quite frankly.
Right.
So on the 10-year yield in January, at the close of the month, so all of our monthly indicators don't flash their signals till month end. So in our ETF, for example, we are rebalancing the first trading day of the next month to react to these monthly signals. So intra-month, they don't matter, they can move around. At month end, on 10-year Treasury yields, we had a counter trend signal from the DeMarc indicators on the monthly 10-year chart. So that would tell us that it's already kind of a little bit old in that it was 3 months ago or 4 months ago that it was registered, but it was just confirmed. The implications of this signal, by the nature of the DeMarc indicators, is about 9 bars. So 9 months, 3 months in, puts us 6 months out for more range-bound, at best, action from Treasury yields. So in falling with what we're seeing from the dollar in momentum terms, we don't have the same loss of upside momentum in 10-year Treasury yields, but we do have that counter-trend signal. That tells us perhaps it's more just range-bound, and that's pretty challenging. But overall, it could ultimately maybe be an equity positive, right? Especially in the second half of the year.
Sure.
When folks feel like at least they're not fighting that trend. So we'll see how it impacts things.
China. I mean, rip your head off.
Yeah, it's kind of in that same category, right? The risk-on trade that we've seen over the past.
So have they been trending? Bitcoin, the NASDAQ, China?
Yeah, so in emerging markets, all the benchmarks are very heavy China. So you can see them in EEM or FXI or the KWEB ETF. All of these have had just impressive, super impressive relief rallies. And, we've been somewhat vocal that we don't want to chase those rallies for the same reasons cited before. They're pretty fast and furious. They've not had enough of an impact yet to suggest that we're going to avoid a retest. So we would prefer to wait for the retest. But we were somewhat vocal, even in Q3 of last year, to say that some of these areas of the market, including China, looked like they're closer to that long-term sort of final low than, let's say, the mega caps, right, which had really kind of just started downtrending in relative terms. So we think that China probably has an important low in place. We don't want to chase this relief rally, but there is some impact to the longer-term indicators. And a lot of the stocks that we're tracking came into some long-term support from 2019 or 2020. And so it seems like the market's memory is still there. We're all kind of feeling, oh, well, that was a pre-COVID type of situation. We have that in our memory. So the buyers seem to have stepped in around those levels, and that could be significant. But again, I don't think we have to, feel like we're going to miss out. No more fear of missing out.
No more fear of missing out. Amen. If we're talking about China, industrial metals, I mean, they've gone hand in hand, and yet, again, a little perspective from my world, the Chinese government did not allow the manufacturing PMI to break out. It did so for the services, as if to say, we told you our consumer was going to come out and spend a lot of money, but we're not going to pour a lot of money into our industrial sector, and yet the industrial metals complex is defying that.
Right. So we have seen with industrial metals, and it actually includes precious metals. So I don't know.
That's interesting.
Well, we've seen the same, right? We've seen a very good sort of 3-4 month rally from metals in general. And that,
is it normal for precious metals to move in lockstep with industrial?
I think they're doing so for different reasons. So
Okay.
I haven't studied that, the correlations over history, but we're noticing some similar, sort of setups between copper and, iron ore, and also gold and silver. And I believe that we have, at least in gold and silver, a nice long-term turnaround in place. The reason I'm giving more credit to that relief rally, if you will, than to a rally that followed a more prolonged downtrend would be the fact that gold was arguably still range bound from a very long-term perspective.
Yes.
And reacting to an
I think my clients have called it stuck.
Yeah.
It was stuck.
Stuck. So and it's stuck also right near long-term support. So an oversold reading on a long-term basis in a wide range is higher probability than an oversold reading after a prolonged downtrend. Right. So we reward gold and silver for that reason in our work. It's one of the 4 positions in the ETF right now. We have a position in GLD that we feel good about from sort of a several month type of time horizon.
I'm really liking this part of the deep dive.
Yeah.
Keep talking,
and so with the industrial metals.
And I don't think we ever thought we would see gold and Bitcoin break out together.
No,
because that was, I mean, that's not the way of the world these last few years, as gold's been stuck.
And this is where, it's like the what and the why, right? It's almost like what our normal expectations would have been of what the drivers are behind Bitcoin especially.
Which gets to your word of discipline, the discipline and the unbiased nature of charts.
Yeah, and by the time we figure out what's the driver, sometimes it'll have changed anyway. But with the copper, for one, we did see some signs of short-term upside exhaustion that led us to also think that China and the equity market there should take pause at a very minimum. So signs of upside exhaustion, gold has them too, but very short-term in nature, sort of digesting. You've already started to see it in silver, some digestion here near term, something that we would see as perhaps healthier than that from something that had previously been downtrending in a more sort of long-term way than gold had been.
So talk to me about your long-term views on bonds.
Long-term, so my long-term.
Your long-term is 6 months. I have to keep redefining. My long-term is like a decade.
So
but anyways.
I would say range-bound. So the bear market cycle that we saw there last year, that was
very
real.
Painful.
That was real and very painful. And I think it showed the risk of not diversifying in terms of your asset allocation. So our ETF has the ability to allocate to treasury bonds. And sort of
you said 4, so I'm going to get the other 3 out of you.
Yeah, so I have short-term treasuries. These are our ETFs, so it's an ETF of ETFs. So short-term treasuries, long-term treasuries, gold, and energy is the exposure at this time. And that's been the case for several months now, and it has not changed, which tells me also that the impact on the long-term gauges of what we've seen of late hasn't really impacted our indicators enough to shift us back to a more offensive sector position, which is the end goal. We want to really leverage the sector momentum.
Sure.
But in the environments where we don't have an uptrend to work with and we don't have long-term upside momentum to work with, we want a place to park. And it is parked in treasuries right now. And treasuries, the short-term treasuries did better than the S&P 500, of course, last year. So did gold to a strong degree. Less so long-term treasuries, right? So that relative performance was really a challenge, and that's why diversifying between other sort of risk off, if you want to call it that, or safe haven types of asset classes helped our performance certainly in relative terms. And it just shows that you can't just go sort of move back and forth between an S&P 500 and a 10-year Treasury position. That's not enough. You have to be more adaptive and dynamic than that. But I suspect that we will see a range, especially if the signal that we're seeing in Treasury yields on a long-term basis, meaning 6, maybe up to 9 months, if those signals are valid, that would suggest that we just see kind of a stabilization. And then the question is that stabilization positioning treasuries better than equities, right? Or is it more in line? I'm guessing it's going to initially be better and then moves to a sort of an in-line relative weighting.
Is there such a thing as charting cash?
The short-term treasuries are sort of like our cash
That's
equivalent,
your proxy, okay.
Right? That's our proxy, and we evaluate them as it pertains to asset allocation. What we're looking at is relative performance, right? So we love to see counter-trend signals on the buy side there, of course, but we really care most about the relative performance there, and as long as those relative trends are doing what we think they should, outperforming in a bear market cycle, then we'll stay with that position. So that's our proxy. We also feel like with an ETF, nobody should have to pay to hold cash in an ETF. So the recommendation there would be, if you want to hold
Right.
cash, hold cash.
Yeah.
Right.
Yeah, I'm putting all of the kids' savings into the First Internet Bank of Indiana. I think it's now like paying 5%.
Oh, there
Go
you
figure.
go.
We're going to have a lesson in our house about compound interest now that we can.
Very good.
So if my clients have been saying last year, they're not saying it anymore, gold is stuck, they've been saying the VIX is broken.
I have heard that too.
The VIX is broken. It no longer signals anything to anybody about it's just broken. Because you see these massive moves in the market, and the VIX is like, who cares?
Our friend David Kodak and I had an exchange
Yes.
about the VIX, and it just somewhat tongue-in-cheek, we were saying, well, when an indicator becomes really widely followed, well, then it loses its value. Maybe it's the same on the flip side, right? Where if something, everybody's given up on it as an indicator, maybe that's also a sign that we should be paying attention.
1969, stocks are dead.
So the way I see the VIX, as mentioned, is a transactional sentiment gauge, and it still is that. The market structure has not changed enough to prevent that. So to me, the depressed reading is actually very much in following with what we're seeing from the risk assets more broadly, that relative performance. So it's kind of acting the way it should. There are days that you kind of scratch your head and say, it should look a little different. So maybe there's some influences there, but I think that the retail footprint that some folks cite as changing sort of the value add from the VIX, I don't think they're strong enough. That's me speculating, but I don't think that there's been enough of a movement into the sort of single stock options to invalidate the VIX as a counter trend sort of indicator.
What about specific sectors? And I'm talking about S&P 500 sectors. GM just went nuts a few days ago, even as Tesla's saying, we're dropping prices, and Ford comes in right behind them. We're also going to drop prices. And I'm like, I think that impacts the revenue. But what about specific sectors? What looks attractive in this environment, and what do you think is beyond the NASDAQ 100?
I think this year, because it will be likely an inflection year, I think we're going to see it change. And in that sort of transition phase, changing from basically defense to maybe something closer to offense, at least by the end of the year, we'll have somewhat neutralized performance on a relative basis on the sector front. Every year, we at least every trending year, you feel like we have this massive dispersion in sector performance. And that's something that we aim to take advantage of with our ETF. Of course, we don't have that environment right now. We have something that we think is a transitioning bear market cycle, likely to be a bit more range bound overall. And in that environment, I think we're going to be forced to be a bit more short term in how we're evaluating these sector sort of rotational moves. We have great tools that we highlight in our research to evaluate the sector shifts on a short term basis. So very short term, meaning like the next couple of weeks, they favored defensives. So we've had pullbacks in relative strength terms, as you can imagine, from consumer staples and healthcare and utilities. And those now are somewhat oversold versus the broader market. We expect a rebound.
Which kind of makes sense.
Right. But then if you take a step back and go from like a 5-day view to like a 6-month view, all of a sudden you start to see the case for rotation back into technology in earnest, right? Technology had been in a downtrend in relative terms most of last year, and discretionary. That's a very diverse sector, so you'd have to kind of pick it apart on the group level.
Right.
So I do think it'll be sort of a transitional year, and with that, the dispersions will actually be narrower than a strongly trending year on the upside. And we'll try to take advantage of that probably at the start with more sort of asset allocation and seeking out defensive positions. But then ultimately we'll look for that opportunity to get the exposure back to the areas that tend to outperform in bull market cycles.
So back to my verbiage, gold was stuck, the VIX is broken, and a lot of my clients would say that spreads are lying. Do you look at high grade, high yield? Can spreads be charted?
You can. I like to read your research to that end. I am by no means the expert there.
Great. So I'm telling you that spreads are lying.
Yeah, there you go.
I mean, we've just seen January, this massive breakout in bankruptcies.
Yeah.
We haven't seen in more than a decade. So you're like, and spreads are like, eh.
So I think about it in market terms. So Tony Dwyer at Canaccord Genuity, I love his work. He's a strategist who kind of incorporates macro and even some technical. And one of the points that he made is markets don't bottom ahead of recessions. Markets bottom during recessions.
Yes, they do.
so what I perk up when I hear things like that. I want to know, what are the market implications, right? And then, of course, we evaluate that from a different perspective. We're evaluating it based on momentum. So I try to, when I look at things that have sort of a macro influence, I actually try to look at them kind of irrespective of what they're known for, like what are they implicating. I try to look at them as standalone. So I look at treasury yields as just their own beast and not as they implicate, what their implications are for equities. And ideally, what you have is a takeaway that makes sense, right? So I'm identifying the trends. I feel like from what I'm reading from all of you macro experts, it feels like we're either in or on the verge of a recession. My indicators from a completely different perspective are telling us that we probably haven't seen the final low yet.
That makes sense.
Right, so it all sort of comes together, and that's when I feel like we can sort of come to a holistic conclusion. So I hope that answers the question.
So we're going to hop to some questions. How have options begun to influence your work, or do they?
We have a lot of clients who are trading options.
Well, yeah, it's become a bigger thing.
Yeah, it's definitely of interest to our client base. By no means are we options experts. We don't provide advice on options in particular. But if you think about it, options are making bets on typically short-term direction. So I don't know how you could trade options, at least over sort of that up to like days to maybe up to a quarter in duration, without having the charts on your side. So we spend time with those clients, just helping them with a directional bias over what their preferred time horizon is.
So I don't think you can answer this question. I don't think God could answer this question. What's the probability that the stock market crashes sometime this year?
Oh goodness, yeah, I have no idea.
Okay,
I have no idea, but I would love to know that.
I think we all would.
But the probability part of it, right? It's like that's what we're just trying to do, is put probabilities on our side. And sometimes we won't be in touch with the market, and those probabilities won't make a whole lot of sense. But what the charts, they won't allow you to be wrong for very long, right? Because you can't argue with a crossover. Like, you have a MACD, it crosses over. Okay, that's a buy signal. And, as much as you might want to, feel other.
Sure.
So the charts they'll kind of keep you honest, I think, is the way to think about it. And we're always working in probabilities.
So in my world, at least, there are massive cross currents right now. There's a huge disconnect between what fundamentals are telling us and what the market is doing right now. Do you ever get this frustrated sense that your charts are misleading you, even if it's just a temporary sensation?
Yeah, all the time.
Okay.
So I would say, when we try to reconcile, and we call it actually the CMT Association, so our Chartered Market Technician designation. The CMT Association, their sort of motto is navigating the gap. And that's the gap that they're talking about, is when the fundamentals perhaps are not aligning with the market price action. So we're here to try to help fill in that gap, right, to try to understand the market at times. So by all means, there are times that we're evaluating things and they don't make a whole lot of sense from a fundamental perspective. But we can still add value by explaining those things as phenomena that are driven by market sentiment. That sentiment can be right or wrong. We happen to feel that it's somewhat wrong right now. But we're only going to fight a trend so long until we start to see breakouts and breadth measures get to a place where they're no longer screaming overbought readings. that's when we'll, concede to the fact that momentum's just strong enough to overrule those things.
Somebody's asking the best way to short the market without leverage.
Oh, we often get that question because, we have to be out there with ideas on both sides of the market at different times. And we usually steer people to inverse ETFs, and we actually steer them to ones without leverage anyway, because we feel like if you're trading the inverse ETFs that have leverage, it's like you're making a bet. Whereas if you're trading one that is, a one-for-one,
right,
it feels like you're saying, okay, either you're hedging exposure or you feel conviction and a directional bias. It just feels like a little bit less of a bet, right? Like you're trying to take advantage of sentiment. So we like, PSQ as something that would be like an inverse triple Q, or SH as an inverse S&P 500 exposure. We'll traffic in those. The volatility products are very difficult. They often trade out of line with the volatility index itself. But they are a bit of I call them kind of a call option, where if you're looking to hedge out that propensity for a volatility spike or a crash or whatever you want to call it, those would be good, but they're very difficult to time.
Well, there's another question that's kind of related to that, and that is, can we ever see the end of a bear market if we don't have a VIX at 40 or 50?
We haven't, so it's not to say it can't happen,
right.
But certainly that sort of high 40s, low 50s area has been kind of normal for bear market cycles. The catch is we don't have a whole lot of bear market cycles to use as our case study.
True. Certainly not in our lifetimes.
Right, especially
somebody actually asked, what's the probability that we go into a 1962 to 1982 regime in the markets? And of course, that was a grind to a very low, low value, the lowest valuation on the market since 1920.
And that kind of question, you'd be in a better position to answer because of your perspective that is a bit more long term. For me, I can't say with any conviction that is likely, right? But I can certainly, if we see this bear market cycle continue, we can at least get objectives using support levels, on the downside.
And that's why I was trying to bring up that for years and years and years, it's not that you were a permeable, it's that your charts continued to confirm the upward movement in the markets.
Yeah.
And it just was
right
what
or
it
wrong.
was.
Yeah,
on
right
a
or
6,
wrong.
Well, but it was right for a really long time.
I guess what I mean by that is right or wrong based on what we were seeing fundamentally, right? So the momentum, and again, sticking to those longer term momentum gauges, which is why we use them as the stuff of our ETF model. That to us is, as sometimes it will eliminate more noise than people are comfortable with, but over history, if you're looking for something to buy and hold, I'm not a big believer in buy and hold, as you can imagine. I don't see why you would want to live through a major downdraft. So if you have a way to avoid those major downdrafts and manage risk throughout them, so like sort of a dynamic long-term buy and hold strategy, which is what we're trying to create with our ETF, that to me is the best way to approach markets. Now, it's not to say we can't get these great opportunistic setups that we can take advantage of. And it's also a great way to, if you really believe in a company or a trend, a thematic trend perhaps, the charts will be fantastic to help you understand which names have the best relative strength, or to enhance what you're seeing. But from a top-down perspective, I really believe in those longer-term gauges, and for now they do point lower still.
What about home builders? I'm wondering if you've looked, because that was the darling trade coming into this year. The entire sell side was pounding the table. KB Homes is like, we had a 68% cancellation rate. Stock went through the roof, and I'm like, okay, but it's massively come off its bottom.
Yeah, it's remarkable, honestly, the uptrend that we've seen from them, and it started even before this year. They were outperforming at a time when you would not at all expect it. And so the right thing, of course, to do would be to respect the momentum until it falters. And it has not faltered yet, not on a short to intermediate term basis. Sometimes we saw Pulte Home, for one, gap up in response to its earnings report. And when you do see a gap up after a prolonged up move, they sometimes are exhausted. So I'm sort of, out there watching to see if any downtick in momentum sort of gives way to maybe even the 20-day moving averages, something like as simple as that. If they start to roll over, I'd be pretty quick to reduce because I want to follow the momentum until it's
this
not
week
there.
we just saw the first pullback in purchase applications, which is a weekly indicator. It's a very, very, very short term, and you're like, wait a minute, I thought it was all good because mortgage rates had fallen, and yet even they found a floor. So, which is interesting with your observation that when you have seen them gap up on very disturbing news coming out on a fundamental level.
The market's very, very hungry right now for good news, and we saw that with Powell's verbiage this week.
Yep.
I think you can speak to that.
Actually, if I don't speak to it, I think I'm going to get shot.
Please do.
Has Powell, does Powell still have a pair? Thank God my mother doesn't know where to find YouTube. I'll just say really quickly that I wasn't convinced one way or the other yesterday that he was convinced, and I think that the market ran with that. I think that the market wanted to hear good news out of him. The one thing that he did do yesterday was he faded jolts for the first time in a long time. He was like, okay, maybe it's a broken indicator.
Oh, interesting.
And that was really what worried the market going into trading yesterday. That's why futures gapped down before the open, because jolts came out so strong.
I see.
And that's been his darling. He's been standing by a broken metric that Fed research has shown to be broken. I still think Powell has a pair. Let's put it that way. And I think with Lael Brainerd probably headed to the White House, that he might even have a better chance of consolidating his power position at the Fed this year. And he said at the podium yesterday, I don't plan on lowering interest rates this year. He said disinflation a million times, but he also said, according to my metric, which is 56% of core services, net shelter, which is a BS signal, but he did say 56%. And in my mind, that's, as far as he's concerned, a majority of the inflation he's following is still too hot. Okay, so
creates a challenge. Yes.
So okay, I answered the question about the Fed. So somebody asked, and I didn't ask you this basic question, so shame on me. How do you measure momentum?
For us, there's multiple ways, so there's no simple answer to that, but we have momentum indicators, of which the MACD is really our primary tool. So it's super common. You can get it online for free at numerous sources, and even some of the platforms, where you hold your account.
I'm going to go do that with spreads after this.
There you go.
Credit spreads.
So with the MACDs, it stands for moving average convergence divergence.
Okay.
It's basically a spread between two exponential moving averages, just the spread, and then it's a moving average laid over on top of that. And that sort of signal line is there to generate the signals in the crossovers. And the crossovers are either buy or sell signals. There's nuances to it. Are the MACDs above zero or below zero? We kind of call it 4 grades of momentum, where it's either positive, improving.
I'm happy you didn't say like 5 shades or something.
Deteriorating or negative. And that's all based on the MACDs. We also will use moving averages at times. So I just mentioned with the Homebuilders, the 20-day moving average, great tool. I mean, if you're seeing a prolonged sort of steady up move, and you just want to make sure that you've got momentum behind it still, just watch that 20-day. As long as it's pointing higher, that's a great way to eliminate some noise and show you price momentum. All moving averages, as you know, are looking back. They're historical. So they will have a lag to them. But that lag is actually a welcome thing to us, because it's eliminating the noise. So you won't get shaken out necessarily. There will be times at which you feel like, oh, I wish I wasn't so late on that turning point. But to us, it puts the more probabilities in your favor that there is an actual reversal going on once you see those moving averages roll over. So we use the MACDs, we'll use the moving averages. We're less using trend lines.
You said you can find these online. I'm talking to the young future chartists of the world. Is there, and we're almost out of time, but has there been in your career kind of a greater adoption of charting, especially since passive investing has really become such a force itself in terms of generating momentum on its own, just flows.
Right. 100% yes. And that was bound to happen. I mean, it occurred in part with the information that we now have access to. I mean, I literally, this dates me, but I used to hand chart. I used to, sit there and draw X's and O's, and So to me, the fact that I can kind of accomplish what I accomplished in 1 hour in a minute even,
I'll never forget my finance professor making me derive the Black-Scholes by hand, and then saying, and on your Hewlett-Packard calculator, you just have to hit this button. You're like,
oh yeah, you should have told me earlier. So, but honestly, that is sort of the best way to learn it, right?
Of course.
To be really close to the market, hand chart, by all means. But now we have such great tools available to us, and the information is out there, so we can educate ourselves. And just the adoption and folks realizing that it's not voodoo, that was a big word. I remember somebody even, maybe Mike Santoli at CNBC, he had done a study of how often the word voodoo was used in the same sentence as technical analysis. And it was quite often. It was actually pretty depressing. That's not the case anymore, right? In fact, CNBC is talking technicals all the time. It's digestible. It's a reflection of market psychology and sentiment, which I think people just have a greater understanding and respect for. So it's been really nice to see a discipline that I would argue 25 years ago felt somewhat nascent. Now it's really grown up. Yeah.
Well, good. Because I grew up in my world, you grew up in your world. Let's come back and do this in 6 months.
For sure. Good to see you, Danielle.
Thanks for being with us today. Appreciate it.
Of course. Thank you.
Thank you, everybody. I'll see you next Fed meeting when I'm back in Connecticut. Thanks for watching. Send any comments in. I might even reply. Take care.